Say someone offered you a refinery, free land, permits already cleared, crude oil delivered right to your gate every morning. Your instinct would probably be simple. Oil goes up, you make money. Oil goes down, you make less. That's how every other commodity business works. It is not how this one works, and the gap between what you'd assume and what's actually true explains almost everything strange about this industry, including why the United States spent 49 years without building a single new refinery from the ground up, and why one finally broke ground this year for the first time since Gerald Ford was in the White House, and gas cost 59 cents a gallon. Refineries aren't one business. They're three, and the size you build decides which business you're in. At the bottom sits the small topping refinery, barely more than a distillation column, splitting crude into its roughest fractions. You can pick one up secondhand for $2 or $3 million, and what you get is a permit headache wrapped around a piece of 1970s steel. In the middle sits the real refinery, the kind that actually processes meaningful volume with hydrocracking units and catalytic crackers and reformers layered on top of the base distillation. That costs somewhere between $5 and $15 billion, depending on how much conversion capacity you bolt on, and every one of those add-ons does two things at once. It raises the price tag, and it raises how much of each barrel you can turn into something valuable. And then there's the tier that just put refining back in the news for the first time in half a century. Who actually owns these buildings has also been shifting. For decades, the integrated majors, the Exxons and Chevrons of the world, held refining as one link in a chain that ran from the wellhead to the gas pump, treating it as a stabilizer against volatile crude prices rather than a standalone profit center. Over the last 15 years, a different model took over. Pure-play independent refiners spun out of those majors specifically so investors could bet on the crack spread without the noise of upstream drilling attached to it. That split matters because it means the stock market now prices refining as its own asset class, one that trades less like an oil company and more like a commodity processing business, rising and falling on margin data rather than crude headlines. It's a subtle distinction, but it's the reason a refiner's share price can fall on a day crude oil rallies, which looks backwards until you remember what the business actually sells. In the spring of 2026, a company called America First Refining broke ground at the port of Brownsville, Texas, on a facility built entirely from scratch, the first greenfield U.S. refinery since Marathon finished its Garyville, Louisiana plant in 1976. The commercial arrangement behind it runs to $300 billion over 20 years, anchored by Reliance Industries, the Indian energy conglomerate controlled by Mukesh Ambani, which already operates the largest single refining complex on Earth. That $300 billion is not the construction bill, it's value of 2 decades of supply contracts sitting on top of the plant. The refinery itself is being engineered to run on 100% American shale oil rather than the imported heavy crude most of the Gulf Coast was designed around, with a design capacity of roughly 168 zuzan barrels a day once it's fully built out. First fuel isn't expected until 2028 or 2029. The obvious question is why it took 49 years to get here. It wasn't the concrete or the steel, it was the paperwork. A greenfield refinery in the U.S. has historically needed to clear a decade or more of environmental review, air quality permits, water discharge permits, community impact studies, overlapping federal and state approval before a single foundation gets poured. Somewhere along the way, the entire industry arrived at the same quiet conclusion: it's cheaper, faster, and far less politically risky to expand an existing refinery by another 50,000 barrels a day than to fight that permitting war for a brand new site. So that's what happened. Year after year, for half a century, capacity kept growing. The number of refineries didn't. The Brownsville project only became possible after more than a decade of its own development work and a deliberate federal push to compress the approval timeline, which tells you the barrier was never engineering. It was regulatory gravity, and it doesn't lift easily. Now the part that actually explains where the money comes from, and it isn't the price of gasoline. It's the gap. The industry calls it the crack spread, and once it clicks, it rewires how every headline about gas prices reads. A refinery buys crude oil and cracks it into gasoline, diesel, and jet fuel. The crack spread is simply the difference between what the refiner pays for the crude going in and what it can sell the finished products for coming out. Wall Street's standard shorthand for measuring this is the 3-2-1 spread. 3 barrels of crude in, 2 barrels of gasoline, and 1 barrel of diesel out. The dollar difference between those two sides is the refiner's gross margin per barrel. In a normal year, that spread runs somewhere between $10 and $20 a barrel. During a genuine shock, a war, a hurricane, a competitor's refinery going offline, it can blow past $30 or $40. Here's where most people's mental model breaks. A refiner does not actually want high oil prices. It wants a wide gap between oil prices and product prices, and those are not the same thing at all. When crude spikes because of conflict overseas, pump prices usually follow, but so does the refiner's own cost of buying that same crude. If gasoline prices catch up to the crude spike quickly, the refiner's margin barely moves. They're just paying more and charging more in lockstep. But if gasoline prices lag behind the crude spike for even a few weeks, the refiner captures an enormous, almost accidental profit during that lag, one that has nothing to do with how well the plant is being run and everything to do with timing they don't control. That's the whole business model compressed into one sentence. A refinery isn't in the oil business. It's in the business of the gap between oil and gasoline, and that gap moves for reasons entirely outside its walls. The 2026 conflict with Iran showed exactly how that plays out in real time. When fighting broke out in late February and shipping through the Strait of Hormuz seized up, Brent crude rocketed from the high 70s to above $110 a barrel within a matter of weeks, one of the fastest monthly surges in the modern history of the benchmark. Gulf Coast refiners running on cheaper domestic crude but selling finished gasoline and diesel into global-linked product markets saw their margins widen sharply during that window, not because they changed anything about how they operated, but because the cost side of their business moved on a different clock than the revenue side. Weeks later, as a ceasefire framework took hold and tankers began clearing the strait again, Brent gave back much of that spike just as fast, falling by double-digit dollars over a handful of trading sessions. The refiners who had hedged that margin in advance locked in the windfall regardless of which direction crude went next. The ones who hadn't watched the same gap they'd profited from evaporate almost as quickly as it appeared. It gets stranger because a refinery isn't even selling one product. Out of a single barrel of crude, it's simultaneously producing gasoline, diesel, jet fuel, naphtha, and liquefied petroleum gas. 5 outputs, 5 separate markets, 5 separate price curves, all moving independently, all day. Gasoline demand climbs every summer during what the industry literally calls driving season, and that seasonal pull alone can widen gasoline cracks by several dollars a barrel above where they sit in winter. Diesel runs almost the opposite calendar, tracking trucking, farming, and industrial output with its own spikes during planting season and cold snaps when home heating oil draws from the same barrel. In effect, a refiner is running 5 different businesses under one roof, hedging 5 different exposures simultaneously just to protect one blended number at the bottom of the income statement. And refiners lean into that reality rather than fight it, locking in crack, spread futures months ahead, so a specific margin is guaranteed regardless of where crude or gasoline prices wander in between. Run it that way long enough, and the description that actually fits isn't factory. It's closer to a hedge fund that happens to own some very large metal towers. There's a second layer of risk sitting under all of this, and it's scheduled on purpose. Every refinery needs periodic maintenance shutdowns, turnarounds, where entire processing units go offline for weeks at a time to be inspected, cleaned, and rebuilt. A major turnaround at a large refinery can cost tens of millions of dollars in direct spending before a single extra barrel gets processed. And while a unit is down, that facility isn't just losing revenue, it's removing supply from the regional market at exactly the moment competitors might be counting on it as backup. Refiners try to schedule these shutdowns for the shoulder seasons after driving season ends and before winter heating demand kicks in to minimize the damage. But an unplanned outage, a mechanical failure, a fire, a hurricane forcing an early shutdown doesn't wait for a convenient month. It hits the crack spread from the other direction. Instead of the refiner capturing a wider margin, the market loses supply and prices spike right as that refiner has nothing to sell. This is also why your gas price has almost nothing to do with the station on the corner and almost everything to do with which refining region your state happens to sit inside. The Gulf Coast is the center of American refining. Texas and Louisiana alone process millions of barrels a day through a tightly packed cluster of plants feeding a shared web of pipelines. If one Gulf Coast refinery goes down for maintenance or repair, 6 others nearby can absorb the slack. The region functions, in practice, as one giant shared safety net. The West Coast has no equivalent. California is geographically cut off from the rest of the country's refining network, and on top of that isolation, state rules require a specially blended gasoline that almost no other refinery in the country produces. Meaning, California can't simply truck in spare capacity from Texas, the way most of the country can when something goes wrong right now. 2 of California's refineries are leaving at the same time. Phillips 66 shut down its Los Angeles area refinery in late 2025. Valero is closing its Benicia refinery in the spring of 2026. Together, the 2 facilities represent somewhere close to a fifth of the state's in-state refining capacity, dropping California to a handful of refineries, serving roughly 40 million people. Economists at UC Davis modeled the aftermath and project that California gas prices could climb by more than $1 a gallon once both closures fully work through the market, an initial jump right after the first closure, with the bulk of the increase arriving as the second one takes hold. Industry groups point to the cost of complying with the state's environmental and fuel blend rules as the reason the plants are leaving. State officials and some independent economists argue the geography problem, a market that can't easily import more supply, deserves at least as much of the blame as the regulation does. Either explanation lands on the same lesson. A refinery isn't just a piece of industrial hardware sitting on a plot of land. It's regional infrastructure. And when regional infrastructure disappears from a market that has no easy substitute, the cost doesn't spread out evenly across the country. It lands entirely on whoever was standing closest to the building that just closed. So if the demand is guaranteed, the margins can be locked in with hedges, and almost nobody else is legally permitted to build a competitor. Why is refining consistently one of the worst performing corners of the entire oil industry? 2 forces are squeezing it at once. The first is that the margin itself has been shrinking. According to the U.S. Energy Information Administration, crack spreads for gasoline and diesel have trended downward since 2022, and the refining segment of the major oil companies' earnings has fallen sharply along with them, down roughly half in 2024 compared with the year before, and running well below where the industry sat in 2022. Capacity has been shrinking to match. LyondellBasell closed its Houston refinery, Phillips 66 closed its Los Angeles facility, and together closures like these have pulled hundreds of thousands of barrels a day of capacity off the market. The longer run outlook doesn't look better. Analysts covering the industry expect U.S. and global refining capacity to shrink further over the next decade as electric vehicles and alternative fuels quietly erode gasoline demand, even while jet fuel demand holds up, which lands on a genuinely surprising conclusion. The part of the oil industry the public blames most for high gas prices is, on average, one of the least profitable links in the entire chain. The EV transition adds a slower-moving but more permanent version of that same pressure. It doesn't threaten every product a refinery makes, it threatens gasoline specifically, which for most refineries is the single largest output by volume. Fuel demand stays tied to freight and industrial activity rather than passenger vehicles, and jet fuel has no realistic electric substitute on the horizon for long-haul aviation. So those two product lines are expected to hold up even as gasoline volumes erode over the next decade. The result is a refinery that increasingly has to fight for a shrinking share of its historically biggest product, while leaning harder on the two product lines it never used to think about as its main business. Some refiners are responding by converting units to prioritize diesel and jet fuel yield over gasoline yield, or converting entire sites to renewable diesel production, essentially betting that the fuel mix of the next decade looks nothing like the fuel mix of the last 50 years. The second force is that the building itself can kill people, and when it does, the bill is catastrophic in a way few other industrial accidents match. On March 23, 2005, an explosion tore through BP's Texas City refinery, at the time the third largest in the country. 15 workers were killed and more than 170 were injured. The cause traced back to a blowdown stack overfilled with flammable liquid during a unit restart, ignited by a spark from an idling truck nearby. Property damage alone ran to roughly $200 million. The refinery had posted over $1 billion in profit the year before the explosion. It had been generating roughly $100 million a month right up until the day it happened. What followed defines the real risk sitting under every refinery in the country. BP pleaded guilty to a felony violation of the Clean Air Act and paid a $50 million criminal fine, at the time the largest ever issued under that law. A separate $21 million OSHA penalty followed, also a record when it was issued. Later, when inspectors found the company still hadn't fixed the underlying hazards, an $87 million fine landed on top of that. By the time every settlement, fine, and mandated safety upgrade was totaled, BP had paid out more than $2 billion connected to a single afternoon at a single facility, on top of a further $1 billion the company spent on safety improvements in the years after. One flawed startup procedure, 15 lives, $2 billion. That's the liability sitting underneath every refinery in the country, every single day it operates, regardless of how strong its margins looked the year before. Step back, and the whole structure looks less like a factory and more like a paradox, the same shape as a casino. It sits at the center of a product nearly everyone on Earth needs every day. With government-mandated scarcity working in its favor, almost nobody is allowed to easily build a new competitor. And it still runs on margins thin and volatile enough that a bad diesel season or a hurricane shutting down the Gulf Coast for a week can wipe out a year of profitability. The crude going in looks like one input. The 5 products coming out behave like 5 separate bets, each moving on its own schedule, with the operator getting paid only for the gap between what it wagered on the crude and what the market hands back for the fuel. Run the numbers on 2 very different refineries, and the split becomes obvious. A small topping refinery, a few thousand barrels a day, minimal conversion capability, built for a few $1 million, can turn a real profit when the crack spread is strong. In a weak spread environment, that same plant sits at break-even or worse, with no scale to absorb a bad quarter. It lives or dies entirely on the spread, with essentially zero margin for error. A Gulf Coast mega refinery is a different animal entirely. A multi-billion-dollar build processing, hundreds of thousands of barrels a day, with full hydrocracking and catalytic cracking capability. At a healthy $15.20 crack spread, a 250,000 barrel a day facility can generate margin in the billions annually before operating costs. At a weak $5-8 spread, that exact same building, staffed by the exact same crew, running at exactly the same capacity, can slide toward break-even. Nothing about the operation changed. The number that decides the difference between a billion-dollar year and a break-even year is set by global crude markets and seasonal gasoline demand, forces almost entirely outside the operator's control. That's precisely why every serious refiner hedges. The only thing more dangerous than a thin margin is an unhedged thin margin sitting exposed the year crude decides to move without warning, which brings the story back to where it started. In 1976, Marathon Oil finished a refinery in Garyville, Louisiana. At the time, just another plant going up in a country that was still building dozens of them. Nobody involved knew it would be the last one built entirely from scratch in America for the next 49 years. That refinery is still running today, expanded for nearly $4 billion in 2009, now processing close to 600,000 barrels a day and ranking among the largest in the country. For half a century, every barrel of new American refining capacity came from expanding buildings like that one, never from building something new. The regulatory and political cost of a greenfield refinery was simply too high to justify. Until this year, when the freeze finally broke at the port of Brownsville, on a refinery engineered specifically to run on domestic shale, instead of the imported heavy crude, the rest of the Gulf Coast was designed around decades ago. That's the real economics of owning a refinery. It was never a business about oil. It's a business about a gap that opens and closes for reasons the owner rarely controls, sitting inside one of the most expensive, most heavily regulated structures in American industry, a structure so hard to replicate that almost nobody tried for 49 years, embedded in a regional network so fragile that losing just 2 plants in one state can move the price at the pump for 40 million people who never once thought about where their gasoline actually came from. Build it in the right place, under the right conditions, and you own one of the few machines on Earth the modern economy genuinely cannot function without. Build it anywhere else, or hold it unhedged through the wrong season, and you'll find out exactly how thin that machine's margin really is. Usually in the same week, the headlines start asking why.